Hello, ladies and gentlemen, and welcome back to our channel. The world stage has been buzzing with activity, and today we're diving deep into some significant developments shaking up the global economic landscape. From potential shifts in international trade policies to crucial meetings behind closed doors, there's a lot unfolding. We've got some substantial news regarding the ongoing tariff situation, specifically involving the European Union and the United States. Several key pieces of information have surfaced, including rumors and official statements that could signal major changes ahead. We'll be dissecting these events, exploring the potential implications, and connecting the dots between various global players. Remember, understanding these dynamics is crucial, as they can impact everything from market stability to consumer prices. We promise to break it all down for you, providing context and analysis. We'll also be exploring the underlying strategies and potential motivations driving these actions, particularly looking at the influence of political figures like Donald Trump and the decisions brewing within institutions like the Federal Reserve. Furthermore, we'll touch upon how these international maneuvers relate to domestic economic goals, such as revitalizing manufacturing sectors. At the end of this discussion, we will provide a comprehensive summary and our key takeaways, so stick around for that. There's a lot to cover, so let's get straight into the thick of it. The interplay between tariffs, interest rates, inflation, and geopolitical strategy is complex, and we aim to provide clarity on these pressing issues that affect us all. We encourage you to engage with this analysis, share your thoughts, and stay informed. Before we proceed, if you find value in our analysis and want to stay updated on economic and political news that matters, please consider subscribing to our channel and hitting that like button. Your support is incredibly important. It helps us reach a wider audience and continue producing in-depth content like this. Also, let us know where you're tuning in from. Drop your city or country in the comments below. We love seeing our global audience engage. Now, let's examine the latest overture from the European Union. Just in, reports indicate that the EU has extended an offer to the United States aimed at abolishing reciprocal tariffs on industrial goods. This development follows closely on the heels of earlier announcements and widespread speculation. Watcher. Guru highlighted that the European Union has explicitly stated its readiness to discuss zero-for-zero tariffs with the US. This represents a potentially significant pivot, especially considering the EU's stance just yesterday, where retaliatory measures seemed imminent. The context here is vital. For some time it had been rumored, and indeed expected, that the EU would respond in kind if the US imposed substantial tariffs, perhaps around the 25% mark, on European goods. The precedent was set by Canada's reaction to similar US tariffs, involving swift reciprocal actions. Therefore, seeing the EU propose zero-for-zero tariffs within roughly 12 hours of potential US tariff announcements is quite intriguing. It suggests a possible strategic recalculation, or perhaps an underlying desire to de-escalate trade tensions quickly. This move isn't happening in isolation. Other nations are also signaling similar intentions. Countries like Vietnam, Israel, and India have reportedly expressed openness to discussing tariff reductions or similar trade arrangements with the United States. This creates a broader picture of shifting global trade dynamics, potentially influenced by a combination of economic pressures and strategic positioning. The desire for smoother trade flows seems palpable among several U.S. partners. Make sure you watch this video until the very end, as we'll be wrapping up with key conclusions drawn from all these interconnected events. Now, let's delve into the driving forces behind these tariff talks and the broader economic picture. A major factor appears to be the intense focus on interest rates, particularly within the United States. Former President Donald Trump has been exceptionally vocal, utilizing social media to relentlessly emphasize the necessity of the Federal Reserve cutting interest rates. His tweets underscore a belief that lower rates are paramount for economic vitality. We believe this persistent pressure from Trump is a significant, perhaps primary reason why we're witnessing these potential shifts in tariff policies across the globe. Countries might perceive negotiating tariffs as a way to appease or align with the anticipated economic direction favored by influential figures like Trump. Or perhaps they see it as a strategic move in anticipation of potential U.S. policy changes related to interest rates and economic stimulus. The connection is multifaceted. Lower interest rates could stimulate the U.S. economy, potentially altering trade flows and demands, making preemptive tariff agreements strategically advantageous for other nations. Simultaneously, there's the ongoing objective, especially concerning China, to bolster domestic manufacturing within the United States. The goal is to reduce reliance on outsourced production and bring a significant portion of manufacturing back home. This America First economic principle inherently involves using tariffs as leverage, particularly against nations with large trade surpluses with the U.S., like China. Thus, the tariff discussions are happening against a backdrop of domestic economic priorities and direct political pressure on monetary policy. The Fed itself is under the microscope, with a closed-door meeting scheduled for today. Rumors, though unconfirmed, have even circulated about a potential emergency rate cut. While the likelihood of such a drastic move is uncertain, and we'll examine the market odds later, the very existence of these rumors highlights the charged atmosphere surrounding monetary policy. Trump's public campaign for rate cuts adds another layer of complexity, blurring the lines between political desire and central bank independence. This pressure campaign is arguably shaping the environment in which international partners are considering their trade stances, making offers like the EU's zero-for-zero proposal perhaps more strategically timed than they might initially appear. The push for lower rates and the tariff negotiations seem intrinsically linked in the current geopolitical chess game. This focus on influencing the Federal Reserve has become a central theme, intertwining domestic economic aspirations with international trade strategy in unprecedented ways. The question remains whether this pressure will ultimately yield the desired rate cuts, or if the Fed will maintain its course based on its independent assessment of economic data. The outcome will undoubtedly have far-reaching consequences for markets and global trade relations alike, making this a critical juncture to observe closely. The anticipation surrounding the Fed's decisions keeps markets on edge, reflecting the high stakes involved in balancing inflation control with economic growth objectives under political scrutiny. The Federal Reserve's actions, or anticipated actions, cast a long shadow over these global economic maneuvers. As mentioned, Donald Trump is actively advocating for interest rate reductions, framing it as essential for economic strength. This public pressure coincides with the Fed holding closed-door meetings, fueling speculation about their next steps. While an emergency rate cut seems improbable based on current market sentiment, the possibility is being discussed. Let's look at the data. Polymarket, a prediction market platform, currently shows relatively low odds for an emergency rate cut in the near term, specifically referencing 2025, but the immediate focus is intense. For the upcoming May 7th meeting, the market consensus, with 72% probability, anticipates no change in rates. However, looking slightly further ahead to the June meeting, the odds shift significantly, with a 56% chance priced in for a 25 basis points decrease. This indicates that while an immediate emergency cut is unlikely, the market does expect the Fed to begin easing monetary policy relatively soon, likely by mid-year. What does this have to do with tariffs? Trump's strategy seems to be using various levers, including tariffs, to create economic conditions that compel the Fed to lower rates. Lower inflation figures are a key prerequisite for rate cuts. Recent data, like the Truflation Index mentioned, which measures real-time inflation, showed a figure around 1.1%, reportedly a 4.5-year low. If official inflation numbers, due around April 10th, confirm this downward trend, it strengthens the case for the Fed to cut rates. Trump appears to be banking on this, suggesting oil prices are down, food prices are down, and declaring there is no inflation, a typically bold assertion aimed at reinforcing his narrative and pressuring the Fed. He portrays the tariff strategy not just as a tool for trade balance, but as part of a larger plan to manage the economy and influence monetary policy. The argument is that by managing trade and potentially impacting prices, even if tariffs initially raise some costs, the broader economic effect might be deflationary pressure or perceived as such. He can create the justification for the rate cuts he desires, aiming to stimulate the economy early in a potential second term. This complex interplay suggests that international trade negotiations might be viewed by the Trump camp partly as a mechanism to influence domestic monetary policy, achieving desired economic outcomes through a combination of external pressure and internal adjustments. The effectiveness of this strategy remains to be seen, depending heavily on the actual inflation trajectory and the Federal Reserve's response to both the data and the political environment. The potential for policy miscalculation is significant, given the delicate balance required. Pivoting to the wider international trade arena, the situation with China remains a central pillar of U.S. economic strategy, particularly under the influence of figures like Trump. The objective of revitalizing American manufacturing is deeply intertwined with the approach towards Beijing. The substantial trade deficit the U.S. runs with China is a primary justification for maintaining significant tariffs. While other countries like the EU, Vietnam, India, and Israel are now signaling openness to zero-for-zero tariff discussions, China's situation is distinct. It's highly improbable that Trump would agree to a complete removal of tariffs on Chinese goods, given the emphasis on correcting the trade imbalance and combating perceived unfair trade practices. However, negotiations are not entirely off the table. Interestingly, one potential area for negotiation mentioned involves TikTok. It's conceivable that some tariff adjustments could be linked to resolving the ongoing concerns and potential ban or forced sale of the popular social media app, which has significant ties to China. This highlights the multifaceted nature of modern trade negotiations, where economic leverage can be intertwined with technological and national security concerns. Even if a deal related to TikTok were struck, it's almost certain that substantial tariffs on a wide range of Chinese goods would remain in place. The core strategy involves using these tariffs not only to encourage domestic production, but also as a persistent negotiating tool. The administration, influenced by Trump's philosophy, wants a tangible return of manufacturing jobs and capacity to the United States, ensuring the country isn't overly reliant on foreign, particularly Chinese, supply chains. This resonates with the America First agenda. The actions of other countries proposing tariff reductions can be viewed partly as attempts to differentiate themselves from China and secure more favorable trade terms with the U.S., recognizing the administration's focus on rebalancing trade relationships and prioritizing domestic industry. The global trade map is being redrawn, with the U.S.-China relationship as the central, most contentious axis. The long-term implications for supply chains, global alliances, and technological competition are immense. Resolving the U.S.-China trade friction requires addressing deep-seated issues that go far beyond tariff levels, encompassing intellectual property rights, market access, and state subsidies, making any quick resolution unlikely despite movements with other trading partners. The strategic focus remains firmly on curtailing China's economic influence, while simultaneously boosting American industrial strength, a complex balancing act with global repercussions. Let's circle back to the European Union's offer of zero-for-zero tariffs on industrial goods. This proposal is particularly interesting given the EU's typical approach to trade regulation. Unlike the US, which primarily relies on direct tariffs, the EU often employs other mechanisms that function similarly. Value-added taxes, or VAT, are a significant tool. When U.S. goods are imported into the EU, European companies purchasing those goods often pay a substantial VAT, which acts as a consumption tax, but effectively increases the cost of imported products, similar to a tariff's effect. Furthermore, the EU utilizes extensive regulatory standards, particularly for agricultural products and food. These regulations, while framed around safety and quality, can make it difficult and costly for U.S. producers, especially farmers, to comply, rendering their goods uncompetitive in European markets. Therefore, a zero-for-zero tariff agreement wouldn't necessarily equate to completely free and fair trade from a U.S. perspective. For a truly level playing field, negotiations would need to extend beyond simple tariffs to address these VAT applications and regulatory barriers. The EU might be very willing to eliminate direct tariffs because they retain these other powerful, less direct tools to manage trade flows and protect domestic industries. They understand that agreeing to zero tariffs might be a relatively small concession if their VAT system and stringent regulations remain unchanged, continuing to create hurdles for U.S. exports. The fact that the EU pivoted so quickly from threatening retaliation to proposing zero tariffs suggests they might see this as a strategic win, appearing cooperative while maintaining significant non-tariff barriers. Trump's team, if involved in these negotiations, would likely be aware of this and push for concessions on VAT and regulations as part of any comprehensive deal. It highlights the complexity. Removing tariffs is just one piece of the puzzle in achieving genuinely balanced trade, especially with a regulatory powerhouse like the European Union. The initial offer sounds appealing, but the devil is truly in the details regarding non-tariff barriers. Understanding these nuances is critical for assessing the real-world impact of any potential US-EU agreement. It's not just about the headline tariff rate. The underlying regulatory and tax structures play an equally, if not more, significant role in determining actual market access and competitiveness for American businesses trying to sell their products in Europe. This structural difference in trade policy approaches often leads to misunderstandings and protracted negotiations between the two economic giants. The constant buzz around tariffs, potential Fed rate cuts, and global trade negotiations inevitably fuels discussions about a possible recession. Market sentiment, as reflected in prediction markets like Polymarket, shows fluctuating concern. The odds for a U.S. recession in 2025 have hovered around the 57 to 67% range recently, though these numbers are highly volatile and reactive to daily news. Yesterday, the chance was pegged higher, while just a week ago, it was significantly lower, around 39%. This volatility underscores the uncertainty gripping the markets. A key indicator to watch will be the upcoming gross domestic product, GDP figures for the first quarter. Current whispers and some analyst expectations suggest Q1 might actually show positive growth. If that materializes, it could temporarily quell recession fears. However, a recession is technically defined by 2 consecutive quarters of negative GDP growth. So, even with a positive Q1, a negative Q2 followed by another downturn in Q3 would still constitute a recession. Conversely, if Q1 is positive and Q3 also shows growth, even with a dip in Q2, a formal recession would be averted. The outcome of Q1 GDP is therefore highly anticipated. Trump's strategy, involving tariffs and pressure on the Fed, could be interpreted as walking a tightrope. The tariffs themselves could potentially dampen economic activity and contribute to recessionary pressures if they significantly disrupt supply chains or raise consumer costs broadly. However, Trump seems to be betting that these actions will primarily force the Fed's hand on interest rates, leading to cuts that stimulate the economy and offset any negative tariff impacts, ultimately preventing a deep downturn or recession altogether. He emphasizes falling oil and food prices and claims inflation is non-existent, aiming to build confidence and provide cover for the Fed to ease policy. It's a high-stakes economic gamble. The fear in the market, reflected in those recession odds, stems from the possibility that these aggressive policies could backfire, triggering the very recession they aim to avoid, especially if negotiations falter or the Fed resists cutting rates as quickly or deeply as desired. The potential for a recession caused by these trade and monetary policy maneuvers is real, even if the immediate GDP data offers temporary relief. Furthermore, the global economic slowdown, partly influenced by these same trade tensions, could also feed back into the U.S. economy, creating additional downward pressure. The interconnectedness of the global financial system means that instability in one major region can quickly spread, complicating the domestic outlook and making the path forward even more uncertain for policymakers and investors alike. The delicate balance between stimulating growth and managing inflation, all while navigating complex trade disputes, makes the current economic environment exceptionally challenging to predict. So, what are the ultimate conclusions we can draw from this intricate web of events? Firstly, the global trade landscape is clearly in flux, heavily influenced by the prospect of continued Trump-style economic policies. The European Union's rapid shift towards proposing zero-for-zero tariffs, despite their initial combative stance, underscores the significant leverage the U.S. currently holds and the desire of allies to secure favorable terms. However, achieving truly free and fair trade involves more than just eliminating tariffs. Non-tariff barriers like VAT and regulations, especially in the EU, remain substantial hurdles that require complex negotiation. Secondly, Donald Trump's primary economic objective appears laser-focused on compelling the Federal Reserve to cut interest rates significantly and swiftly, potentially early in a second term. He seems to view tariffs, inflation data, and public pronouncements as tools to pressure the Fed into action, believing lower rates are the key to economic prosperity. The success of this strategy hinges on inflation remaining low and the Fed's willingness to respond to political and economic signals. Thirdly, while the focus is often on tariffs, the underlying goal for the U.S., particularly regarding China, is the revitalization of domestic manufacturing and the reduction of trade deficits. Tariffs are the means, but the end game is a rebalanced global economic order with a stronger American industrial base. This will likely keep U.S.-China tensions high, regardless of deals struck with other partners, although avenues like the TikTok situation might offer unique negotiation points. Fourthly, the risk of recession remains a tangible concern, reflected in market volatility and prediction odds. While near-term indicators like Q1 GDP might be positive, the aggressive use of tariffs and the uncertainty surrounding Fed policy create significant economic headwinds. Whether these policies ultimately stimulate growth or trigger a downturn is the central question. Finally, the situation is highly unpredictable. Rumors about policy shifts, like the alleged 90-day tariff pause, which the White House denied, highlight the speculative environment. Trump's negotiating style is known for its volatility. Therefore, while we see countries positioning themselves and proposing deals, the final outcomes of these trade discussions are far from certain and will depend heavily on ongoing negotiations and the specific priorities pursued in the coming months. The interplay between trade policy, monetary policy, and domestic economic goals will continue to be the dominant theme shaping the global economy. Investors and businesses must remain vigilant, adapting to rapidly changing conditions and policy signals in this dynamic environment. The long-term consequences of these strategic decisions will shape international relations and economic structures for years to come. Thank you for joining us for this analysis. Remember to subscribe and like if you found this breakdown helpful, and let us know your thoughts in the comments.